It used to be that when you asked your friends or colleagues what they were investing in, a typical answer would include some mix of stocks and bonds. But today, their answers might sound a little more complex. Everyday investors can now round out their growth portfolios with investments that fall outside the traditional asset classes. And they're broadly grouped into an asset class called alternative investments. Some examples include gold, oil, real estate, hedge funds, cryptocurrencies, and collectibles. So why are investors adding alternative investments to their growth portfolios? Let's run through some of the most common reasons. Number 1, diversification. Alternative investments add to a portfolio's diversification because their value isn't often closely related to that of stocks or bonds. That means if a stock or bond price falls, alternative investments may not follow suit. Of course, it's important to keep in mind that the reverse can also be true. Number 2, as a hedge against inflation. Inflation is the rate at which the price of goods and services rises over time. During times of inflation, the goods you can buy for $1 today will cost you more than $1 to buy in the future. This can be a problem for fixed income investors, especially because the rate of return on those investments is usually lower to begin with. So inflation will eat away at their already modest returns. Alternative investments like real estate, precious metals, and other commodities tend to hold their value better during periods of inflation. And number 3, accessibility. Many alternative investments used to have a high barrier to entry, meaning you usually had to be classified as an affluent client or an institutional investor to invest in them at all. But more recently, there's been a stronger demand for them from everyday investors. This inevitably encouraged fund companies to package alternative investments into assets that are more commonly accessible, like ETFs. Now, it's important to keep in mind that alternative investments typically have unique risk profiles and may not be suitable for everyone. Taking your time to do enough research on any you might be considering is a must. Some specific questions to consider are: how are they regulated? How are they valued? How liquid are they? What are the costs to invest? Am I investing with a lot of emotion? And how do I invest in one? This list is by no means definitive, but it can provide a place to start.